Good morning. Dornbush download 38. No, I
38.
haven't sort of changed my voice because I'm trying to be impressive. It's Sinus
Kim
Hill.
Carnes.
Sinus Hill here
Kim
at
Carnes.
Dornbush. Kim Carnes. Now you're showing your age. Anyway, Andrew, Dan, good morning.
How do?
And how do? And bit to talk about today. Great reception last week about our budget video, so thanks very much. And if you haven't looked at Dornbush, download 37. I know all of Michael's groupies have downloaded it and uploaded it and shared it and whatever else you do on social media. But today we're going to be talking...
I didn't know there were so many 70-year-olds on social media.
Neither did I, and frankly, neither did Michael's wife. But that's a whole other story.
We won't go there.
No, not at all. So today we're going to spend a bit of time talking about a new IPO that we're doing. Dan, you've done a fair bit of work on it. It's It's Argo Infrastructure.
Global infrastructure.
Global infrastructure. So do you want to run a bit with that?
Yeah, I wasn't too interested initially, Andrew, because we've got that other one coming up, which I've called Voldemort, because we're not allowed to mention the name of that one. So Voldemort's coming up, and I was probably more interested in that. But once I did a bit of digging, and that's my phone going off, into Argo infrastructure, it's quite interesting, and the demand for infrastructure going forward is going to be massive.
Do you want to quickly talk about who Argo is? Because a few people might not know who Argo is.
Argo. So a listed investment company, asset manager. So they manage assets that are listed or on companies purchased on the share market through a listed investment company, and they charge a small fee for doing that.
It was started by Don Bradman after cricket, so based in Adelaide. It's been going 60, 70 years. I've got my kids' money in Argo. And yeah, there's Dan's piece of paper here, $5 billion of money they look after, and they've already got 75,000 shareholders. Yeah. So they're now diversifying into this global infrastructure.
Another interesting stat, there are 23,500 self-managed super funds on the Argo register. So, you know, that sort of says there's going to be a bit of demand for this as well, I think.
And look, they are very straight. As I said, I've got my family's money in there. They're very straight shooters, nice people, but, you know, they've got very much, at the moment anyway, just a very straight Australian equities focus. Yes. So they're saying, well, let's diversify a little bit. Let's put this new listed fund out there that might suit these 23,500 self-managed super funds and their 75,000 clients.
Yeah. And looking at the big picture, they expect $57 trillion needed for global infrastructure investment by 2030.
Wow.
So that's just massive money,
so it's
isn't
15 years, basically.
Yeah.
57 trillion.
And we know why infrastructure, you know, think of toll roads.
Think of Toowoomba, the second range crossing.
Yeah,
you know. Think of Wagner spending $200 million on an airport. Think of the inland rail. I mean, even just in our own region, we've been starved of infrastructure for 30 years, and you know we're not Robinson Crusoe. So that 57, billion is probably actually a fairly low number, I would think.
I think a lot of that though will be in the US. A lot of infrastructure over there needed. Essential services. And the thing about that is it's demand through every cycle, isn't it? So, you know, the money just keeps coming in whether the share market's in a slump or not.
But I think the issue from Argo's point of view is here in Australia there's like 12 listed infrastructure companies, whereas offshore there's something like 320 or something like that.
Yep.
So
amazing.
The big issue is our economy is too small. You know, and so to tap into that 57 billion over the next 15 years, Argo are really going offshore and looking at these other 300 odd offshore companies and how can we do it? And you're quite right, 70% of them are US. You know.
Very sticky money, predictable cash flows, high entries, high barriers to entry, I suppose, isn't it? You know, because it's such a infrastructure. Well, what are they going to spend on the range crossing? It's such an expensive commodity to get into.
Correct.
And then, you know, it's sticky money where the income just keeps flowing through.
Predictable cash flows. More of a growth investment than a dividend investment. Projected dividends meant to be about 3%, and I think the growth's about 8 or 9 forecast, not promised. And it's interesting that Argo have actually done some research as to how portfolios look, what it looks like with it in, and it actually reduces the volatility and marginally increases returns as well. So certainly from our point of view, it's something we'll be talking to all of our clients about, because we like the management, we think the investment theme looks good, and how they're going to go about it ticks a number of boxes in our world. But the key nasty, if you want to call it a nasty, is, you know, everyone's in this yield chasing mode. Everyone's banks, everyone's Telstra, 5-6%. It's not that type of investment. It's more of a low volatility income, low volatility growth style investment with above inflation income. So,
and I think hopefully next week we'll be talking a bit more about growth when Voldemort comes up.
When we can talk more about Voldemort. It starts with G, I can tell you that. But when GV comes about, and that you're exactly right, that'll be sort of more growth focused, but about a 5% fully franked dividend, but it's probably more at the pointy end. Whereas what we're talking about with Argo is much more, could go in, I would argue, general advice, pretty much any portfolio. You know, it's that type of investment, whereas G, is very much more specific, targeted, much more volatile, much potential for bigger returns, but more risk. So wouldn't suit everybody.
No.
Dan, what have you been buying this week, or looking at buying this week?
Well, we've sort of had a look at IMF Benthanthum, hey? So
It's an interesting one.
see the charts on that. That 15-year chart that we'll put up on the screen. You know, it's in that channel, isn't it? Yeah, now. I don't know. There's could be a bit of a downside still there. Yield's good.
What does the business do, for those people who don't know? What does the business do?
They fund litigation basically, and that's just not going away, is it? You know?
Sadly, we are such a litigious society that you're right, you know, that they're going to be, and they've got hundreds of millions of dollars of funding on the go, and they take a slice of if there's a win.
Yep.
And so they sort of do their, I can't remember what their percentage is, something like 40 or 50% of wins that they have, but it's quite large, the wins that they have, but equally so it's quite lumpy as well. You know, they might go through a period of time.
That's an issue, isn't it?
And in fact, their share prices come off a bit because there was an appeal where they thought they'd won, and then they actually...
ANZ appealed it.
ANZ, yes, thank you.
But now they're going back and seeking leave to appeal that decision. So
interesting
and that's
looking chart,
law, isn't it?
Yeah, interesting looking chart, and the business itself looks interesting too. But again, not a blue chip, more at the pointy end.
But if it drops away and you can pick it up around that $1.50, $1.60, worth having a serious look at.
About $1.80 at the moment?
$1.86, I think.
Yeah, so a little bit more downside potentially. Anything else? I know we spent a lot of time talking about Argo, and rightly so. As we said, we really like Argo. Is there anything else that you wanted to cover?
I don't think so.
So time for coffee. You'll be in Dan and Michael's capable hands. I'm off to Paris next week, so I'll be checking out what the implications of Brexit, which is likely to occur, Greece leaving the euro, and the implications there. So I'll be back in a couple of weeks' time. I'll leave you with Dan and Michael. Till next time.
Cheers.